Thank you so much, Maurice and Charles. Thanks for being with us today. My name's Carrie McKellogg. I'm the Chief Program Officer at REDF, and I'm the CEO of our Impact Loan Fund. We wanted to bring up a panel, so if I can ask the panelists to come up while we get organized. We have a great panel today. We have two social enterprise practitioners who are in the trenches doing the work. We're going to talk about it. And we have two funders who have been financing the work. Sure, go ahead and take a seat. I'm going to do some brief introductions and let them have a chance to speak about themselves. We might be missing a panelist. Alberto? Yeah, you can just grab a mic. Sit wherever you like. That's fine. Okay. So as I mentioned, we have two practitioners and maybe two funders, maybe one. I'm also a funder, so I can wear both hats. But let me paint a picture of you for what we're talking about when we're talking about access to capital. These are businesses that we mentioned are competitive in the market. They provide goods and services. They have to do that at a competitive price. But they do that with a labor force that is transitional, that has to be invested in, and then leaves the business, and they do it all over again. So if you think about trying to run a small business, welcome, Alberto. Come on down, just in time. If you think about trying to run a small business as it is, and you add the complexity of a labor force which needs some help, and then leaves you as soon as they are trained up for the competitive labor force, that's what these small business owners are working on. So they are heroic, and we're gonna introduce them all and get started. Hi.
How are you?
Hello, good, come on down. Let's start with Dan and Amy, who are our social enterprise practitioners.
Oh, good afternoon, everybody. My name's Dan Rhoton, Executive Director here at Hopeworks Camden. It's awesome to be in this group. Fundamentally at Hopeworks, what we do, like most social enterprises, young adults who are struggling with multiple obstacles walk in, often making less than $400 a year. Right now, when they walk out, they're making over $43,000 per year with an over 89% 12-month retention rate. We do that with technology, right? We train them in front-end web development, geographic information systems, digital mapping. We train them in those skills. We provide those services to companies as large as American Water and Comcast and as small as mid-sized companies all over the country. They get the experience, they build a portfolio, and then, you said it, they leave us. But not always. I'm really proud to say that right now, 30% of our full-time staff are alumni of our program because we hire the best. So it's really exciting to be here today, and I'm really excited to be with this crew.
Hi, everyone. My name is Amy Chasan. I am the CEO of Sweet Generation. We are a bakery based in Bushwick, Brooklyn. We just grew from a teeny tiny little hole-in-the-wall bakery in Manhattan to a giant warehouse space that houses a cafe, an event space, a huge production kitchen, and classrooms in order for us to run our youth job training program. We think of what we do as really creating a space, a supportive space for young people to learn, to grow, to discover themselves, to work, to learn what it means to work, and to grow. And we're really proud to be able to hire many of the young people that go through our program, and not only just hire them at entry level, but also advance them in our organization into senior leadership.
So for the funders here today, when you introduce yourselves, can you tell us a little bit about how your financial institutions came across social enterprises and sort of what part of the financial institution is driving this interest in social enterprise? So maybe we'll start with Bank of America and Alberto.
Hey, so good afternoon. It's good to be here. Alberto Garofalo. I am the proud president of the great state of New Jersey for Bank of America. Longtime partner, Dan. It's great to see you. Great to meet you. I also am the chief CRA officer for Bank of America. I lead a series of responsibilities, and I've been with the firm for 19 years, and it's really great to be here. Now, did you have a question for me specifically, or do you want to go around first?
Maybe we'll get into that.
Okay.
Hi, everyone. Michael Lohr. I'm a managing director in the Goldman Sachs Urban Investment Group. We're a business that really provides capital to underserved communities across the U.S. And I've been on that team for over 11 years now, and I guess we'll get into the questions on how we got to that, but our team is really dedicated to deploying capital into underserved communities.
Great. So we're going to start with the social enterprises, and what I'd like Amy and Dan to talk about is how you think about different forms of capital when you think about growing what is a double bottom line business. You have certain expenses that can be covered with revenue and certain expenses that probably cannot. And so just how do you think about it when you think about funding your organization? Maybe start at the end.
Sure, yeah. I started this organization really bootstrapping it, raising money from my community, from my network, from friends, family, people that I met in my former career in youth development. And obviously that only goes so far. And so I really quickly realized that I needed to reach out to local banks to support this initiative, this program. And so I was really fortunate to be able to secure a small capital loan out the gate, just a $20,000 loan to be able to purchase equipment. A lot of that was because I had been able to, launch this crowdfunding campaign and tap into the network. That took us, just so far. And we realized very quickly, though our doors were open and we were selling cupcakes and coffee, that cupcakes and coffee don't quite pay enough to provide the supportive services necessary that young people that may not have had other work experience really need in order to continue their the support in their career development. And so we started to apply for grants. We were really fortunate to be awarded pretty early on a very large grant from the District Attorney's Office of New York, which helped fund our expansion to the Brooklyn location, and also helped us secure future loans both from banks, and then most recently we were able to secure a loan from REEF, which
Which we'll talk about.
yeah.
Yeah. Dan?
That's awesome, by the way. How we think of how we use different fundings is we kind of think, and again, we think employment social enterprises are great, but we really view employment social enterprises like Hopeworks, like Sweet Generations, as kind of the solution to the worst parts of philanthropic funding and a solution to the worst parts of market-based funding. Worst part about philanthropic funding, from what we see, is you can spend all this money and things don't change, right? Because too often with philanthropic interventions, there's not an end game, right? We're going to provide services, we're going to keep people where they are, we're going to keep them supported. They're going to need the same funding next year, right? All too often with market-based funding, right? Selling cupcakes, selling websites, it's fundamentally inequitable because the market is unbalanced, right? The competitive nature of market-based funding means you're always going to hire the best, most ready candidate that's the cheapest to onboard. The way it's designed is you're not going to look for candidates that are risky, and you shouldn't if you run a good business. Combining those two streams solve both problems. When we use philanthropic funding to provide all the supportive services, right? Number one, we eliminate the market-based concern. By the time our young adults at Hopeworks are finished, they have experience, they've worked with clients, they have exceptional skills, and a track record which removes the risk for the market-based hiring, and in fact makes them better because we can also make sure companies are hitting their DEI and social impact goals. Our candidates are actually a better bet by the time we're done. However, right, we can't provide those supportive services to get them there on market-based funding and pricing because that makes us non-competitive. Philanthropic dollars can cover that gap, and it's a great philanthropic investment because there's an end game. That young adult you're supporting now with career readiness coaching, finding housing, connecting to mental health, won't be on that dime a year from now because of employment social enterprise. And in fact, probably even faster because they're going to start earning money from our social enterprises before they're even done with us. So we really view that braided funding as the way to do it.
That's really interesting. Thank you. So for Alberto and for Mike, what were the investment decisions at your firms to get you into this space? Is this really through the kind of philanthropic side? Is this about business development in some market? Were there certain geographies or the fact that these certain target populations was what brought you to the table? And then do you think about it differently than you think about just funding non-traditional nonprofits? Do you think uniquely about the social enterprise model, or, how does it compare?
Well, I guess to start, so, our business, the Urban Investment Group, is really, as I noted before, focused on deploying capital in low-income and underserved communities across the U.S. And so that takes a variety of different forms. We focus on the built environment, providing housing and essential services like places to get, grocery and food and the like, but also focus on education and as well as the businesses that are in those communities. And so Goldman Sachs as an organization has a variety of different pockets of capital that are designed and thinking around some of these components. We have our 10,000 Small Business Initiative, which is really designed to provide both education services and access to capital to small businesses across the U.S. We also have our Launch with GS program, which is really designed to provide capital and services to entrepreneurs and fund managers. And then we also have our 1 Million Black Women Initiative, which is really designed to provide capital at various stages of a Black woman's life, with different access to capital, different services, and the like. And so when we think about our investment, it spans across all those things, but it also spans across just the traditional kind of CRA investing that we do as well. And so the way we try to think about it is, our investing and what we're doing is really just part of our natural DNA. And so if you're deploying capital at scale and being very direct about what that's doing, you can create impact across a variety of different things. And so when I think about some of the things we do on the built environment side, that creates jobs. And how are you thinking about different job training opportunities? If you're working on a public housing project, are you making sure that there's jobs actually being created in that housing project itself? Black Power, who was supposed to be here today, but Danelle just had a baby, so he couldn't. They are really addressing a need in terms of an aging building stock across the entire U.S., particularly here in New York, many of which are in low-income communities and are being overlooked in terms of the clean energy. And so they're really looking to address that problem, but then coupling that with creating jobs for the people that are living in those communities. And so that was one of the things that was compelling to us. And so I'd say it's really more about being very intentional about the investment decisions that you're making and thinking about what those impacts are, but then trying to couple that with sometimes philanthropic support, sometimes city capital, sometimes other forms of capital to really create a dynamic investment that really is both investable, which we think helps scale it, but also provides the impacts that are important to those communities and to the public sector.
Thank you. Look, for us, this is core to who we are. It's core to our strategy, and it is deeply embedded in our philanthropic strategy and our giving. But it's also deeply connected to our overall strategy of driving responsible growth, which is really about driving shareholder value, client value, and ultimately value for the community. I think secondly, it's also one that, although is broad and national, and I'll talk about some examples of that, it's also a very localized strategy. So myself, I'm the president for the state of New Jersey, and there's 93 markets like me that represent essentially across the country. So to your point about geography, we're not only looking at across the enterprise, but what are the local needs specifically? And yes, we're investing in historically Black colleges and universities, in Hispanic serving institutions, but we're also investing in social enterprises locally where the needs are actually happening and where they matter most. And then third, this is what we call the genius of the and. This strategy allows us to, as I shared earlier, drive shareholder value, drive client and impact locally, impact the communities, but also impact society at large in addressing this very needs, which frankly, allows us, Dan and I have had a partnership since 2000, I think it was, where we not only partnered with the organization, but in addition to the philanthropy and to the dollars, we also have a vested interest. So our strategy is, yes, we're going to go and invest, but we're also going to take our leadership and our volunteerism and invest in the infrastructure of the organization. We have an emerging leader program. We have an executive director program. And that's all part of this sort of broad commitment to, yes, we're going to continue to invest, but we're also going to take our leadership capital and partner with these organizations so they can maximize that success.
Great, thank you. That's and we can get into more examples as well, because I think it really kind of brings the point home. I'd like to talk about what's missing and what we could do more. I think we can talk about different forms of capital. There's philanthropic dollars that have been deployed here. There are debt dollars and there are equity dollars in Goldman's investment in Black Power. And those are different channels. But there is still a lack of finance that's coming into the social enterprise sector. And what most people will tell you is that it's a complicated, it's a small business. So you're essentially underwriting a small business, which is already relatively risky just given the nature of small business. But when you add on top of it the complexities that we talked about, often there's not a lot of fixed assets. Often there's not a lot of collateral. Often there's a lot of seasonality in the work and in the revenue. So rather than tell you how challenging it is, I will just say, like, finance is a very creative place, and you as financiers know that it can get really creative. And I think the what is potentially missing is bringing some of that creativity into how to underwrite and finance the growth of these businesses. So I would like to hear from the entrepreneurs themselves. You know, if you had a magic wand, what is sort of the key piece of capital or of the way that finance could come in to grow your business that you would really benefit from and you would want this audience to hear about?
I think if we had that magic wand, and if you have it, I'll stay after. I think the key thing for Hopeworks and organizations like us is it is important to be clear what you're paying for. And what I mean by that is if with philanthropic or investment dollars, you are demanding extensive process, you know, that's what you're asking for to acquire that, you will get process. You will get theories of change, you will get flowcharts, you will get all of those things. If you want, return on investment, that's okay. That's kind of like how the thing works. It's important to be clear on that and be clear on what the return you expect is and what the differential is. What's the delta between just a high value return on investment? If your key thing is outcomes, you're going to ask for different things from the Hopeworks of the world than if you're only looking for process. You know, I go to the best burger joint in the world. I pay for the burger, not to watch the guy do it, right? Now, the truth is, of course, we know this, like, actually, most investors are looking for all three, right? And that's reasonable. What is difficult is when a person like Hopeworks has to guess what's your top two. You know, transparency about what portion of your investment you're looking for return on, what portion is outcomes, and what portion is that process can, number one, make sure that someone like me can say, we're a good bet for you, right? Because that's the worst case scenario for us is when we attract investment, whether philanthropic or otherwise, where our set goals are different than the investors, right? And then the second thing is it allows us to say, if we're not a good bet, we can find someone who is, right? There's a place for your dollars. And if you don't know where it is, we probably do, right? But I think being clear about like what exactly the return is it outcomes? Is it process? Is it monetary return? And where do those three things fit? Then we can really rock and roll.
And in full disclosure, Amy just went through a process with the REDF Impact Investing Fund of closing a loan. So I'm sure she has lots of suggestions that she could offer on that, and we're very willing to hear.
It was actually such a positive experience, especially having gone through a traditional bank loan process. You know, what made it different was that it was not just black and white numbers on paper. It was really talking about what do we do, what are our goals, what are the things that REDF was interested in seeing in terms of impact. What do we picture our future to look like? How are we going to get there? What happens if this doesn't go through? What happens if we have Omicron times 11? You know, what happens in these real life scenarios? I think, you know, right now we're facing that big grant that we got. It was over $2 million as a tiny organization that funded us for 3 years. So when I look back at last year, we had like $750,000 of basically free money, right? Money that we don't have to pay back, money that was there to help us grow and sustain us. And now we're falling off a cliff. Now we have $200,000 this year. And so what is that, how do we fill that gap? What do we do? And so part of our strategy has been looking for investors, looking for loans that support what we're doing, understand what we're doing beyond just the black and white numbers on paper, because they don't always look as good as a traditional business might look, because we spend more money on staff, we spend more money on labor, we spend more money on supporting our team. And so, you know, when I think about what's missing, it's the consistency of support, it's the reinvestment when an investment has already been made, and whether that's actual dollars or investment in helping the social enterprises find new money, find new access to sustainability. That's, I think, what's really critical in this sector.
Point Point taken. Thank you. And Mike, can you talk a little bit about there's a discussion about shareholder capital, stakeholder capital, valuing different people's perspectives in underwriting and investment, and just how when you made your investment in Block Power, how that evolved and how your thinking on that evolved as it went?
Yeah, sure. I mean, look, I mean, there's a lot of different types of capital that we provide, but if focusing on the Block Power example, we did two things. First, we made an investment in the company, and second, we provided a loan facility to basically finance projects that they're doing. And I think about them in two different ways. The first was, and thinking about from the business owner standpoint, you have to think about what capital is right for you. And work with your capital providers to understand kind of what each piece means. And so if I think about the Block Power case, like they have a very compelling market thesis on how they're going to address the fact that you have an aging housing stock that's basically energy inefficient. And so when you think about just the opportunity set at large, it's massive. So when we think about just an opportunity in an investment in the company, if they're able to address even just a small segment of that market, there's a huge market share opportunity. But really what was interesting about it from the social enterprise standpoint is they actually have a really direct investing thesis in terms of deploying capital into those underserved neighborhoods, providing jobs and providing basically services to people. And so that's one part of the equation that not everyone looks for. And some people, quite frankly, are scared of that, right? So they don't really understand exactly what that means. They don't want to spend the time on it. And if you're really deploying capital into these neighborhoods, there's in many cases not a lot of data, right? So you can look across, the entire, country and look at data on people that have solar leases and the like and see default rates that doesn't exist in these neighborhoods. And so how do you draw that parallel and comparison is very, quite frankly, hard to do, but also not that hard to understand. I mean, if we look across our portfolio, have massive investments in affordable housing projects. So if you're doing energy efficiency retrofits in those buildings, you shouldn't feel that uncomfortable that those are also going to be repaid. And so that's really the kind of thesis into the lending opportunity was, let's provide some necessary capital for the business to run its operations, as you noted, and give the necessary infrastructure. But that only goes so far if you don't have the capital to scale your actual business growth. And so we thought about the opportunity of how can you actually help fund those project finance and those opportunities to scale the business opportunity while providing, alongside other investors in the company, the necessary infrastructure.
Thanks, that's really helpful. And maybe for all panelists, we've talked a little bit about the impact of the work and how we think about the impact that's generated. But for Amy and Dan, how do you really talk about your work? How do you measure the impact of your work, and how do you talk about it with funders? And then from the funder perspective, what is it that you're most interested in understanding about the impact?
For us, I said it at the beginning, that's the whole thing. It's what's the delta on income? Are folks moving from not working, no income, or into living wage jobs? That number is garbage if they don't keep it, right? So that's the second one. And our research, and I think that it says, if you hold a job for at least 12 months, you're kind of in the workforce then. Does that make sense? You might get promoted, you might go up, but you're going to be, for our folks, right? And that means our delta is about $40,000 in 1 year for one candidate, right? If we place 100 folks, I'm very aware of doing math in my head in this audience, by the way, right? But that's pretty good, right? And then if they keep it, right? So, your return, so about 90% are still going to be working a year later. So that means that's your second year, right? So that's the thing. Does that make sense? And for us, there's lots of metrics that you can use to see if you're on track to do that. But kind of if I'm driving to LA, how do I know I did it? Is when I arrive to LA. The metrics that I have in the meantime are, did I make it to Ohio? Am I in Oklahoma? But I can't report out and say, hey, we 10 people made it to Ohio. That means 0 folks are in LA. That's a weird analogy. Does that make sense? But the point is, sometimes it's really simple, right? It's how many folks got jobs? What were their wages? What's the delta, right? And then are they still working 1 year, 2 years, 3 years later? That's, for us, is the thing.
Yeah, at Sweet Generation, we really focus a lot, in terms of impact, we focus a lot on the perceived value that participants have in the program. what do they take away from it? What do they walk away feeling like they gain from participating in our program? Our staffing model now, over 85% of our entire staff, including senior leadership, are former participants in our program. And so we feel like that is a great signal of satisfaction in employment and success in our program. And so for us now, we're trying to figure out how we translate that out to funders, because we're really focused. We're stepping in. We think of it as a preventative approach. So we work with some organizations that work with formerly incarcerated youth, but the vast majority of the programs that we work with are just working with young people that happen to live in low-income communities. And so we're really thinking about, this is just, for many of them, just their first job. What was it like for us to have our first job? And what was it like to have a first job that was really supportive? And how can we give them that support, that feedback, and that mentorship so that they come out of it, whether they stay with us or they move on to become a banker? How do they feel about the experience that they had? How confident do they feel coming out? What can they reflect on in terms of what they're taking away from this opportunity?
Great, yeah.
Yeah, so look, in terms of measurement, a lot of what Amy and Dan were saying is really spot on, and is also one of the many ways that we ultimately look at it. But for us, we look at it through a sort of three-prong approach or lens, right? What's the impact to the key stakeholders, to the communities, to the associates, and ultimately society? And obviously, we have a qualitative and quantitative approach that not only allows us to meet the highest standards in terms of policy, regulation, and requirements, but our own sort of standards in terms of what we do and what we give. Of course, we've got traditional key performance indicators: jobs retained, wages, impact, your traditional sort of metrics and scorecard-driven approach. Of course, we have all of that, but one of the most important ways is what Dan was ultimately talking about. We partner very, very closely with the organization, and we're part of the success. So we have visibility, right? Like, I know for a fact that 99% of all of the young adults that go in are making $400 or less. How do I know that? Because I'm vested in that organization. I understand it. I also know that as an outcome of that, those on the other side are making $43,000 or more on average. How do I know that? Because that's part of the process that we measure. We are part of the solution, but we're also measuring it alongside, and those are the impacts that we're also interested in. And there's other examples, right? So we partnered, and this is locally in New Jersey, we partnered with the African American Chamber of Commerce. We gave them $100,000 for an ex-offender program. So not only did we give them that funding, but then we sent all of our resources, and we're doing financial literacy. We're doing education. And we're seeing the impact real time that it's having to the potential that these ex-offenders are not going to have to go enter the workforce. And by the way, we're also part of the solution, because we're on the other end. Once they finish the program, we have the ability to place them into jobs. And we've got commitments to place them into jobs. So, yes, it's your traditional sort of KPIs, quantitative and quantitative approach, but it's also working very, very closely with the organization to make sure that they're successful.
Yeah, I mean, look, measuring the impact is really, I think everyone said a lot of that here, so I'm not going to repeat it all, but there's a lot of different ways to measure it, and I think on top of just trying to collect the data and thinking about how the breadth of all the things you're doing, it's also really important to think about some of the case studies and things that worked, and then try to replicate that. And so being a part of the investments, as Alberto noted, like actually being on the ground and understanding what's happening there allows you to report back on what you did, but also think about ways that you could leverage that and scale that and do that in other places. And speaking for Danelle at Block Power, one of the things that they're working on is a workforce initiative where they're literally training people who are incarcerated to do the work that they're doing. And what they find valuable to that is it provides a resume opportunity. It shows that you had a job, and then their best outcome for them, although they'd like to maybe retain some of those people, is that they actually get jobs with the contractors that they're working with. And so that's a measure of impact if I think about a specific example. And so it's really being intentional about some of the things that you want to do, but then learning from those and trying to scale that.
So we are trying to figure out in our own lending practice what is real repayment risk and what is perceived risk and what is bias that is just baked into finance underwriting, period, right? And we're finding that challenging, one, because there is an absence of alternative ways to measure risk that don't have maybe some of those biases baked in. But we also are an intermediary. We have funders. And so we are also worried and thinking about who we're reporting to while we're trying to innovate. And maybe I'll put Alberto on the spot a little bit as the CRA officer of a bank. Are there policy level changes or sort of big picture CRA level things that would incentivize lenders to be more risk taking in the sense of like trying to prove that a social enterprise can repay and not kind of taking for granted or just assuming some of the metrics about liquidity and access to capital are the reason why you should not lend to somebody? Are there any kind of lessons we should be maybe, we can pilot things at a little level, but things at the big level you see?
Yeah, so look, I think it goes back to the point I stated earlier. This is at the core and at the fabric of our responsible growth strategy. And when it starts, with the CEO, when it starts at the core foundation of your philanthropic strategy, that this is part of what we're going to do and how we're going to do it, the CRA credit and eligibility becomes an after fact that happens. And if you look at the history of CRA ratings and performance, ours has certainly been outstanding. We're actually right now in the middle of an exam for this 17 to 20 year cycle. So we're spending a lot of time talking about the outcomes. And I think my advice would be, it's a two-way street. There has to be an extreme level of transparency between the funders and the lenders and the organizations to understand each other, to educate and provide awareness. And when that happens at the ground level and organically, then you're able to make partnerships like ours work and many others, where you're driving significant benefit to the organizations that are focused on these most underserved communities. You're impacting society. You're impacting the employees. You're bringing the talent into your organization. You're solving the wealth gap, and you're also getting CRA credit for it. So it's at the tail end of that. It's not the reason why we did it, but it's embedded into the culture, and that is really important. And it's about organizational strategy. And for us, that's very core to who we are.
Comment on policy changes?
Yeah, well, I don't know if I'm allowed to comment on policy changes, but I would say that, kind of piggybacking off that a little bit, the business that we're in, it's profitable, right? This isn't philanthropy at its core. I mean, there are other sources of capital for that, but when banks are doing this, they're doing this because, one, it makes sense. There is an investable opportunity set, and it drives impact, and which has a ripple effect. And so, there are certainly things that are going on in terms of at least financial institutions where we're held to a certain regulatory environment, and there are things that we need to think about. Some of which have helped to make those investments and incentivize those with different ways to think about capital and the like. But broadly, I think it's about really figuring out ways to pair public and private capital and philanthropy to make an investable opportunity set. And so there's certainly been policy changes to help with that. There are things that have driven at least making it easier for banks to do certain things, to hold things longer, to implement changes, all of which are net beneficial. But it's really also just making sure that these opportunities can be profitable and that you're incentivized to invest in them.
I'm going to give the last word to our social enterprises to just sort of sketch out where your vision is, like where you guys are going over the next few years and where capital, again, blue sky, ideal sources of capital and combinations of capital that would help you get there. And we may have some time for Q&A from the audience, so we'll open that up.
For us, kind of like how we kind of summarize this moment for us is kind of like our foot is in the door and we want to kick the door down. And what I mean by that is every company that used to tell us that we prefer bachelors or maybe we'd like, right? Companies are ready, right? And not only that, maybe the market driven is the reason they've come to us at first. Our folks are killing it. And then they're coming back, right? And so that means that our biggest operational risk, right, is we want to meet that need now when the market wind is at our backs so that when there's a contraction and there's an option to go back to the bad old days, why would you? So that's what we're trying to do in our market, right? We're trying to scale, we're trying to meet the employer demand, we're trying to meet our business demand. And so thinking about you with growing, as we're opening additional locations, right? We're trying to get more space so we can do more. Timing is important, right? If we can build these pipelines with multiple companies now, when it's the time when the business case is so dramatically and abundantly clear, we can do that now and do a good job, which we will, right? I'm clearly biased, but we'll do great, right? Then building a diverse, inclusive workforce is not the thing you're doing for the credit. It's part of the process now. It's how we do things. And when there's a contraction, when times are tough, why would you do things the bad way when the way you're doing it now is so much better? That's what we're trying to do in this moment.
Thank you.
Yeah, going through this expansion, there's so much on the horizon for us at Sweet Generation, and we're really thinking about our business growth, our organizational growth, as exponential opportunity to employ a significant number of young people in our enterprise. And whether or not they stay with us is, of course we want the best of the best to stay with us forever and ever, but better than that is to send them out in the world to pursue whatever unique interest they might have, and do it with the foundation that they've created while being at Sweet Generation. And so over the next few years, our growth, we look at it internally as a means of sending out the young people that come through our organization, sending them out in the world, to get that next level job that they likely would not have gotten if they didn't have an experience with us.
If I may, and I think Amy and Dan will appreciate it. It goes back to your question about the overcoming the risk biases and, frankly, the need for more innovation. I don't know about you, right? But I won't tell you how old I am, but I was born in the 70s. You could do the math, and I don't remember a time in history where there's been a more important time for organizations like ours and others to innovate and do more to support the investing in organizations like this. The need has never been greater as far as I'm concerned. And because of that, we think we need to go beyond the norm and sort of the traditional approach and really sort of think about ways to innovate. A few examples that demonstrate that, so it's not just words, it's sort of meaningful, right? So we've announced a $1.25 billion commitment over the next 5 years to address social inequality and social economic challenges. As part of that, we've already allocated $200 million to minority-focused organizations like this that you see here on stage. Secondly, we have programs that we've innovated, like the Neighborhood Builders program, which you're also a prior recipient of it, where you provide funds directly, unrestricted, that the organization can use. And then in addition to that, you provide leadership capital to train their emerging leaders and executive directors to maximize the impact. And the last point I'll make is, look, we understand that traditionally there are times where financial institutions like ours may not be a fit. How do you innovate? How do you solve for that? We're the largest investor in community development financial institutions. We have a portfolio of about $1.6 billion, and we invest directly into over 250 community development financial institutions. So when we can't, we invest in organizations that can, and it's an innovative way for us to provide access to that. As a matter of fact, we built a national directory of that, so that way we can educate and create awareness so that organizations, when traditional financial institutions can't provide, you have access to that, and we continue this commitment, whether directly or indirectly.
Go ahead.
Yeah, no, I think you just asked me to just talk a little bit about kind of the future for our business, and I think a lot of that resonates here as well. I mean, for us, we were looking at kind of the things we've done, and I kind of noted this in my opening remarks. It's about being intentional, and so we look back and saw, wow, we've actually invested a lot in minority developers who are investing in real estate, but how can we actually be more intentional about that? And so we definitely have initiatives focused around how can you actually be really thoughtful about investing in those businesses. I noted earlier on about the firm's 1 Million Black Women Initiative, which is a 10-year $10 billion initiative, and we've already invested close to $1 billion of that. And so And that's not just us, that's firm-wide. So I think that, when I think about the opportunity set in front of us, there's a lot of things that have happened, for better or worse, particularly, in the midst of the pandemic. But what's come out of that is a lot of people being really thoughtful about how to drive change and how do you use dollars and how do you think about that. And so I think one thing for us is just continue to do what we've always done, but be more intentional about those investments, working with Block Power to create initiatives to have workforce training and workforce development, thinking about other businesses that could benefit from that as well, and really just thinking about how you get innovative with those dollars and how you find the right programs and right ways to deploy capital into really important and impactful initiatives.
Great. I want to thank my panelists and give them a quick round of applause, and we'll open it up for some questions. Thank you very much. Absolutely.
Hi. Hi, I'm Oscar Parabela with Next City. I'm curious about, this past 2 years have been a very unique time for everyone. So I'd love to hear what it's been like for all of you. For the ESCs, was there an initial huge influx of applicants coming to your programs in spring 2020? And also, maybe even more importantly, over the past year, has it been easier to place folks? Is it getting harder to keep folks? Are the folks who are alumni, are they getting higher starting salaries as a result of these tight labor markets we've seen over the past year? And for the bankers or the investors on the panel, over the past year, I'm curious if you're having other colleagues in other parts of your organizations, just small business loan officers, perhaps someone working on Union County, New Jersey, or Trenton, or Camden, or wherever, saying, "Hey, look, I've got a restaurant. I'm really worried they're not going to repay this loan. Can you help me help them find a workforce employment social enterprise kind of partner to help them staff up so they can repay this loan that I just made?"
You want me to start with it's a great question. And I'll go back to the point that I made earlier. I mean, a part of what's really important to us is not only is it a national embedded strategy, a lot of what we were talking about, but it's also a very local strategy. So I think to your point specifically, yes, we do that. And I'll show you, and I'll give you an example of how we do that. We have a process that's called a community needs assessment process, where my team, and this is happening, by the way, nationally. I'm giving you the example of New Jersey, of what you talked about in Camden and some of these other areas, which I know very well. We meet with all of the key influencers, all of the major nonprofits and or organizations that we either partner with or that are prominent in those communities. And we have what's called a community needs assessment. What are the needs? What's changing? What are the most pressing needs? We align that locally. And then that ultimately determines what my local philanthropy strategy is ultimately going to be. So if things have shifted and there is a need for more qualified candidates or better financial literacy programs, we're going to pivot. We're going to invest in those areas and or partner with organizations so that we can deploy capital and to organizations or point them in the right direction where they can get access to the very areas that they're telling us is the most pressing need. And again, it becomes a really sort of repeatable process that allows us to be very nimble year over year. Because, there is some consistency. There are some things that come back and emerge. But obviously, what we saw over the last 2 years has been unprecedented. It allowed us to react to that. Food insecurities is a perfect example, right? They were exacerbated by the pandemic. As a result of that, we went in and dramatically increased the giving that we provided to food services. The Food Bank of New Jersey is one example of that that we've done. That was as a result of that program. Hopefully that answers the question.
I think that was a great question, by the way. I think kind of three things that we saw. The first thing is, somebody said this, and it's true, the whole rising tide lifts all boats only works if you're in the pool. And what we found is our young adults returning from incarceration, experiencing homelessness, they are not connected to the economy, which means that when times are really, really good, times are rough for them. When times are really, really bad, times are rough for them. And that we saw that pattern happen more. Does that make sense? That's the bad news. The good news is we are seeing dramatic changes. First, we're in tech, right? Our young adults can work remotely, and often transportation and where they work is a big barrier. it's been bonanzas. We actually quickly pivoted and we built a co-working space right next to our training space for our alumni so they can work and have good internet, have their little office, have their phone booth. It is packed, right? Wages are going up, right, for sure, especially in tech and especially those entry-level tech positions where our folks hit. The other thing that we are definitely seeing is for our social enterprises, right? The combination of really good web development, geographic information system, all that, and the ability to have demonstrated social impact, like that's a winning formula for us, especially now. So we've seen a massive thing for opportunity, and I said it before, our biggest operational risk is we want to make sure that all this stuff is in cement, you know, before the environment changes, right? So that's been our experience so far.
Yeah, we're in food service, so it probably goes without saying, COVID devastated us. I mean, it destroyed us solidly for a long time, and we are clawing our way back and trying. You know, when we signed our lease in Brooklyn in February 2020. So I'll let you fill in the gaps of what happened over the next 2 years. You know, and so we're now in a position. We opened a year ago in Brooklyn, but at 20% capacity. We can have 130 people in our space. It's a big space. We could only have 20% of that for many months. We couldn't do any events. We couldn't do any of the services that we had planned on doing. And so now that things are starting to open up and young people are starting to come back into the community-based organizations that we partner with, and we're able to run our internship on site again. This is why it was so critical for us at this moment to partner with REDF to get an additional investment to recover from what truly devastated us, because there is so much potential on the horizon, especially as our industry rebuilds itself.
And I think we have some more questions. Yeah, go ahead.
I'm Mary Bogle from the Urban Institute. Doing that math in my head while you guys are talking. You know, a lot of the way I think of in my work with community level metrics and metrics with disinvested neighborhoods is looking at scale as population level impact. That to me is social impact. Very impressive program level impact being reported here for graduates retaining in jobs, 90%, right? But that is far from population level impact in terms of entire communities, who's the outreach pool, who actually enrolls, who graduates. So the denominator matters. And what I wonder about is, how do you get to scale without public systems putting into this capital stack? Because even the impressive amounts of money you're talking about are nothing compared to WIOA dollars coming down through mayors and governors. So I heard one speaker who I was very impressed with earlier kind of brush off the public systems, but I wonder if that's really feasible. Can we afford to brush off the public systems? And how do you all think about capital flows from the public sector, especially investing in that human capital piece? That film, one of the themes running through it earlier was the amount of housing problems people had. And you looked at the housing people were in, it was hard to imagine how they could be stable in their well-being and retain jobs given the failures of the public sector in providing decent housing space.
I'll start, and while the rest of you can, that's a good question. It's a hard question. Yeah. So social enterprise originally was created because of a market failure, right? This was like an employment model that the traditional workforce system wasn't servicing, and that's why these largely private, market-based solutions came about. Which I think, a lot of us are attracted to this work because it imposes some of the discipline of the market on something which generates social impact. That's great. But over time, I think we've seen there is a role for public finance in a social enterprise. There's sort of two pots that, as an intermediary, we've identified that are a good fit. One is USDA has employment and training dollars for people who are on food stamps, the objective being to get off of food stamps and into a job. The things that they pay for are exactly the things that social enterprises are doing. They're training, They're building up skills. So when there's a source of public money that is well suited to the intervention, yeah, it should be part of the capital stack. I think the second pot of money that you would think is the right one is WIOA, right? These are Department of Labor dollars for workforce training. They have not proven to be particularly, I'm going to let them use whatever adjective they want, suited to this intervention. And so there's a mismatch there. And that's where I think the policy conversation can go.
Yeah, just to start on that, I think it's really how you work to pair them together, right? And in certain instances, especially a lot of things we worked on, you noted housing. I mean, we do a lot of large-scale housing projects, both of which have private dollars and public sector dollars, and they're complicated, and there's a lot of complexity behind them, but there's massive gaps in these projects given the capital needs. You know, you see what the capital needs that NYCHA has, you see all these, very necessary affordable housing projects, which just can't support the cash flow needed for the cost to build it. And so there's certainly a place for philanthropy or public sector dollars and what have you to where we come in is to leverage those dollars and to make these projects, ultimately feasible and ultimately, but partnering with them to make sure that they're designing the impact that you have. I think there's other places where, as I noted with the kind of data problem and people just having a perceived perception of risk, sometimes, unfortunately, they can be, people just won't invest in them until there's the data behind it. And so I think in some cases you can use that to provide subsidy or some risk mitigant, stop loss or what have you, to help create these pilot programs or to help them get to scale. I think if you start to do these and see the data and the impacts of them, hopefully 5-10 years down the line, you actually have an opportunity set where you don't need those dollars. So I think it's always, in my opinion, going to be a part of the equation. But just having their limited capital sources, right? And so you have to figure out the best way to leverage those to create as much impact as possible while being cognizant of the population problem. I think that there's going to always be a constant need, and so there's a limited resource. You got to use that resource as best as possible.
I think it's a great question, and I'm not sure I'll give you the solution, but I'll give you a perspective, perhaps, of how we're sort of thinking about it. And it starts with really diversified approach to, I think, the complicated needs that you alluded to. So when you think about our 1.25 billion strategy, it's multi-pronged. It's not one area of focus, it's multiple areas of focus. So, part of that investment is around workforce development, social enterprise is a lot of what we're talking about here. That's one approach. But you also have other areas. You've got healthcare that we're looking into invest in and continue to do more in. You've got small businesses which have very, very specific needs that were also exacerbated by the pandemic. And then you've got, of course, affordable housing. And there's lots of examples of the amount of investments that we're sort of leading the pack in terms of affordable housing and the impact that that's having. We're going to do that because that's core to our strategy. And I said it earlier, it's part of our responsible growth strategy. But what we're also trying to do is we're trying to go out there and give really specific examples so that others can join and align. It is my belief that if we align around this common purpose, private and public, then you start to potentially have the impact at scale. So one example that I can give you, right, is, we have a very specific jobs initiative where we are partnering with either historically black colleges, university, Hispanic serving institutions, social enterprises, collectively, and we're saying, hey, what is the actual workforce need in terms of the jobs that we think we're going to need 3, 5, 10 years from now? Your lens, our lens. And then we say, okay, what are the skill sets that we need to train to go and be able to equip, individuals in low to moderate income areas to be able to be skilled at these roles? And we're partnering with organizations to now not only investing in organizations, right? So we've given significant amount of dollars to organizations like this and other universities to help us build the curriculum, but we're also part of it. We're helping build the curriculum for the jobs that we're going to hire to, and oh, by the way, we're going to commit to hiring them. And if you think about that, and you start to share that in the private and public sector as a commitment that we're doing and invite others to join, then I think we have a potential to align around a common purpose and a common vision to then at scale make the impact. We're going to do it irrespective, and we're inviting others to do more.
Last word to Dan, and then.
May I? Oh, no. I would just say two quick things. First, I would say the description of WIOA as not well suited to the task of is an exceedingly generous description of WIOA. And I would actually gently say that workforce development programs' addiction to WIOA money is one reason why workforce development in communities has such a horrific reputation. So I'll go on at length with that later if you're interested. I think the second thing I would gently push is scaling for effectiveness does not mean one program has to do it all. It means using the right tool for the job. For example, what Hopeworks does and social enterprises do, I say our specialty is we take folks who are not engaged in the economic system and we pull them in to living wage jobs, stability, stuff. Once that's done, they are vulnerable to the policy level changes that can really make change. Earned income child tax credit, right? We saw during the pandemic, one policy change in that, massive levels of poverty changed. You know who it didn't help? Folks who don't file taxes, right? Folks who don't have the paperwork. Folks, that's us. Does that make sense? So I would say the tool of social enterprises like Hopeworks is to take folks who are not in the system, earning illicit income, right? Sex work, drug trafficking, right? All those things, all those ways people have, bring them into living wage jobs where suddenly they can take advantage of tax credits, right? Policy can actually then have a meaningful impact on poverty because everybody's in the pool, you know, and I think that's the tool that like the Hopeworks of the world can do.
So there's some products in the foyer from Sweet Generation, and if you have website design needs and other social media, Hopeworks in Camden. Thank you so much to the panel.
Thank you.
Thanks for sharing.